It's been almost 2 decades we've been on this journey to educate, liberate, and help you take action so you may better manage your financial future, achieve peace of mind, and accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you set your goals and guide you along the way to help you achieve them. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. I'm your host, Johnny Dean, with our own Rick the Professor Plum, Chief Financial Planning Officer. Managing Your Financial Future, Johnny Dean, Professor Rick Plum here. Welcome back. Another podcast, another session, more good topics. Good stuff. You know, we hear we get a lot of feedback, Professor, from our various listeners across the country. They have certain suggestions, and I say, okay. You know what you can do with your suggestions? No, I'm kidding. Actually,
I want to hear them.
Well, one of the suggestions was that we make it longer than like the typical 20 minutes. I don't know.
Okay.
I don't know.
Unusual. Most people want me to be, quieter.
Yeah, well, that was one of the things. And the other one was, do we talk about one single topic or do we have a multitude of other topics?
That would be yes.
I would put that, is it better to do that? There are some who have said they like when we talk one topic, and there are others who have said, yeah, no, it's nice when we cover a multitude of topics. So I don't know. I have a couple of different topics for today's, and I thought I would try this multiple topic thing and just see how it goes. Okay. And these come from emails. If you want to email us, you can certainly do so. Go to luciacap.com, and you can ask us questions there. But I want to start with one because it refers to a topic that we had a couple of podcasts back. And this has to do with the mortgage strategy we were talking about, where it relates to putting money into the Roth IRA. You know what I'm talking about.
Right. Instead of accelerating your payments if you have 15, 20 years left, or instead of using a 15 instead of a 30 to be done in 15.
Correct.
Using a Roth IRA for that excess money that the 30-year payment allows you each month.
Yeah, exactly. And it's a strategy I don't hear much anywhere. In fact, I've never heard it outside of our show at all. But anyway, this from somebody who only signed their name as the letter K. So I will say K is asking this question. Heard your show about the mortgage strategy. I really enjoyed it. Question, is paying off a mortgage actually more of a cash flow issue if you have the money to do it? Now, this is a really good question because there were times years ago when everybody said, always pay off your mortgage. It's a huge amount of interest and all this stuff. Think about what you're paying. But with money cheap now, Professor Plum, that answer is not so pat anymore, is it?
Not so much, but is it a cash flow issue? And it has a lot to do with your attitude towards making a monthly payment and or your attitude towards investing and maybe missing out on potential returns. Also, where the income is coming from to make that payment on that monthly basis. It's probably not a bad thing to pay it off. Is it a good thing? We'll see. But a lot of people, the question is, so you've got a $250,000 mortgage and you've got $250,000 not earmarked for anything else sitting in cash at your local bank.
Right.
If you don't pay off the mortgage, what are you going to do with that cash? If you said, well, I'm just going to leave it in cash, I'd be leaning more towards paying off the mortgage then. If you say, I can invest it, and where are you going to get the money for making the payments on the mortgage that you didn't pay off now? Well, I've got my Social Security and I got a little pension, and I got my portfolio, the rest of my portfolio, and we've got pretty good cash flow. And well, then you could say, then don't pay it off and invest it. Now, at this point, it becomes, do you care about creating a bigger nest egg for the heirs, or do you care about not having a payment? There's something to be said about not having a payment. Now, paying off the mortgage doesn't mean that the entire household payments are going to go away. You still have insurance. You still have property taxes. And this is actually something that I've been thinking about in the last couple of weeks, really. I've been going through some things, jotting down some notes.
You're talking about you personally, in your personal situation.
I've been putting some notes and some comments and some things down so that if someday I'm not here and my wife is by herself with the portfolio, the assets, the house, and all those kind of things, at the present, the house is not paid off. There would be if I were to go to the great beyond.
If you were dead, we won't beat around the bush. If you kick the bucket tomorrow.
Yeah, there would be sufficient cash to pay off the house.
Thanks to insurance and all that.
The insurance and other things, yeah. And so the question is, if I were advising her, if I somehow through from the great beyond, would I tell her to pay off the house? And my thought process at the moment is at least to consider, well, pay it down to a very minor mortgage, relatively small mortgage, something that's easy to make the payment on. And then using the monthly payment, impound it and take that property tax bill that comes around a couple times a year, but not every 6 months. It's less systematic than that. Take the insurance payment that comes around every 6 months or so, or a year, depending on how you pay it, and make it into a monthly bill, because from what I've seen with other people, monthly bills are easier to deal with. A monthly budget we are accustomed to. We're dealing with it. Periodic large payments, and depending upon the size of your house or the state you live in, property taxes can be a fairly large number on a periodic basis. It's hard to, you have to, basically you're either going to impound yourself by saving the money so it's available when you need it,
yep,
or it might not be the worst thing to have a small mortgage, as you mentioned, because interest rates are so low right now. Lock it in for 30 years. You're not paying much for it. You're not giving up much for it, but put yourself on a monthly payment. That way, then you can make the payment automatic out of your monthly budget, and you can go travel. You can go do things without having to worry about, oh, darn, I need to make my property tax bill today, and it's X number of thousands of dollars. Where's that going to come from?
One of the old, as an adage or maybe just pieces of advice way back used to be, don't ever have an impound account. Don't ever have an impound account. I was told that when I bought my first place. At the moment,
I don't have one.
In the late 80s. Well, see, there you go. Now, I had one because I said, I know that when I get to the December, and especially December, but December and April, when our property taxes are due, that I'll have forgotten about it, and I'm going to have to dig into some cash somewhere. And I was like 24 at the time, and I didn't have the cash. I said, I need something to put this away. I need somebody to handle this for me so that I don't forget. And there's something to be said for that, as you just mentioned.
My first house that I bought, I did have an impound account, and because when you only put X amount of dollars down that I did on my first house, they required the impound account. When I bought the second house, they didn't require one because I had a large enough down payment. They weren't too worried about it. And so I am impounding myself. Every month I have X amount of dollars from my paycheck moved over to a separate bank account that I use for all of my non-monthly bills. I've turned it into a monthly bill coming out of my paychecks. But I still have to remember to actually make the payment. By doing the impound, for somebody who maybe doesn't want to have to worry about, deal with, or play with the idea that, okay, December and April, as John said, we have to make these big payments. Just be part of the monthly bill. This isn't for everybody, and I'm saying I wouldn't keep a big mortgage this way necessarily, because cash flow, I think, is a big issue once you retire.
Yeah, and as you said, turn it over to somebody.
My wife's had me to deal with it for the last X number of decades.
Yeah.
And it's not that she can't do it, not that she wouldn't even want to do it. It just makes life easier, I think. And so I'm thinking about it when I get to the point where I have the ability, I have the money in the bank to either pay off the remaining mortgage or not. Do I want to pay it off completely, or do I just want to pay it down to a small number and impound it and be done? Put it on autopilot from that point forward.
Yeah, I mean, what you're doing is you're not, if you're concerned about paying all this interest, because you do see over the course of 30 years how much interest you're paying, it can look like a whole lot of money. But if it's a smaller amount, a much smaller amount, the amount of interest is, what you're bringing up is, because the emailer had asked about cash flow, but you're bringing up another aspect that isn't thought of all that much, which is just convenience.
Like I said, yes, you could pay off the mortgage, and now you do not have that payment. But you still have some other payments associated with that home ownership. Property tax being the larger usually of the two, and homeowners insurance. Some homeowners insurance, they can do it on a monthly basis. I don't seem to do that. I seem to do it on an annual basis. But I've impounded myself, like I said. But it's coming out of my paycheck right now. When it's coming out of my investment portfolio, it's going to be a different game. I think that and I'm not there yet. I haven't done this. It sounds appealing to me at the moment. As I mentioned, I have not done it.
Yeah. Again, this is a different story. If we were back in the 10% mortgage era of the late 80s, early 1990s, as I recall, we were.
If you're not worried about the convenience of paying off or paying the impound account and all that, if we're just going to talk about the mortgage, it has a lot to do with your attitude towards making the payments. and what you would do with the money outside, and where are you getting the money to make the payment. But it's generally not all that easy to make sure that you have that payment every month coming out of the money that you would have used to pay off the mortgage.
Yeah, and it's a personal preference kind of thing.
It's a risk tolerance type of thing. It's where is the money coming? If you've got, like I said, got Social Security, then paying off the mortgage isn't as big of an issue. If you're trying to take the money and invest it to make the principal and interest payment on a monthly basis, then it becomes more difficult. A more sophisticated, aggressive investor. Given today's interest rates, you think mortgages are low. Have you seen what the banks are paying on savings?
Almost. We're almost back at the whole zero, 0.001. I think
bonds aren't paying much.
Bonds are paying very little. We had a 10-year discussion I did a week or two ago, and I haven't looked at where it is today, but I'm sure it hasn't moved a whole lot. Just something to consider for you folks.
It's gone down, John.
Is it really? As of right now, and we're talking early August, where are we on that 10-year?
0.56.
Yeah, it was 0.65 or something, I think, last time we talked.
0.61 before.
6.1.
Now it's 0.56.
Okay, well, can it go lower? It can always go lower until it gets to zero. All right, so that's topic number one. Thank you for that question, Kay, or whoever you happen to be. Here's another one. Another interesting question, and we may have to explain this just a little bit. Sanjay in San Jose, California. What good are the income limits on a Roth IRA if we can simply do Roth conversions and get around them? Now, I think what Sanjay is referring to has to do with what we call the backdoor Roth, or at least that's what I'm reading into here, Professor Plum.
You're asking me to make a logical answer on Congress's laws.
Yeah, good luck.
But he's right. I mean, we have the ability to now. Remember, if you want to go back in history, Sanjay, when Roth IRAs were first created back in 1998. There is an income limit for who can qualify to put new money, contribute new money to a Roth IRA. And at that time, there was an income limit on who could convert money from a traditional IRA, traditional retirement plan, to a Roth IRA. If you made more than $100,000, regardless of whether you're single or married, you were not including the Roth movement, you were ineligible to do a Roth conversion. It wasn't until 2010 that they took that income limit away. So it was designed with the idea that people that made more than $100,000 could not do conversions either. In 2010, they took that away because not enough people in their mind were converting, or spoken another way, not enough people were paying taxes. So they opened it up so that higher wage earners could do conversions, even though they weren't going to let people contribute. The reason, being cynical, the reason was they wanted tax dollars. They still weren't going to let you have tax-free growth without paying big dollars in taxes to get the money there. But it's there. So we have the rules that they've set forth. And when they set forth rules, we find ways to use those rules either to our advantage or we just don't use them. The backdoor Roth IRA is still a wonderful way to save and to build tax-free potential money in retirement.
Well, let's talk about how this works now, because if I make more than, is it still 100? Did we just say that? Is it 100,000?
Well, that was a conversion number.
No, but I'm saying as far as contributing to a Roth.
It's like for a married couple, it's 196,000 or so.
But for a single, yes, I can't remember. Okay. But anyway, whatever it is, there are income limits. But if I want to get money into a Roth IRA, let's just explain very quickly how the backdoor Roth works.
So if I'm single and I make more than $139,000, I'm ineligible to make a contribution directly to a Roth IRA. And if I have a 401k or some kind of retirement plan at work, whether it's a pension, 401k, profit sharing plan, whatever, and I make more than X amount of dollars, less than that number, I cannot deduct the contribution to a traditional IRA. But that doesn't mean I can't contribute to a traditional IRA. It doesn't matter if I'm working and I have a retirement plan at work. There is no phase out of contributions to a traditional IRA. I can contribute to a traditional IRA as long as I have earned income and as long as I have earned income. That's about it right now. They've even taken away the age 70 and a half limits on traditional IRA contributions. So I can contribute. The question is, can I deduct the contribution? And if I make more than X amount of dollars, and not a very high number for that matter, I cannot deduct the contribution. So one of the things we can do, though, is if I make more than, let's call it a married couple making more than $206,000, I cannot contribute directly to a Roth IRA, but I can contribute to a traditional IRA on a non-deductible basis. Because they took the limits away for conversions in 2010, I can then convert that money that's in my traditional IRA to a Roth IRA. And if the only money that's in my traditional IRAs is that $6,000 or $7,000 of money that I put in to the traditional IRA and did not deduct it, there's no taxable event when I convert that non-deductible money, which is 100% of the IRA at this point, over to a Roth IRA. So yes, it is skirting the rules, at least from the original intent of the rules, but Congress changed the rules. So we're living up to their rules. We're doing everything by the rules. Everything is completely above board and legit, and it's just using the rules that they've given us to our advantage. So should we want to. Now, there is a little bit different though, because if I contribute to a Roth IRA and I need my money back, I can take that money back at any time for any reason, and I just have to tell the IRS that I'm taking my contribution back. If I've done the backdoor Roth, and this is maybe the first or second year I've done it, if I'm within 5 years of doing it, I can't just take the money back because it's not a contribution. It's a conversion. And if I remove the converted principal from a Roth IRA within the first 5 years of the conversion, and I'm under 59 and a half, even though there's no taxable event, it's still a penalty.
Yeah.
So there is a difference between the contribution and the conversion. It's not a big deal. People that are doing this because of income limits, they're making more than $200,000 a year for a married couple, more than 135 for a single individual. They typically are not jumping and getting that $6,000-$7,000 back out of their Roth IRA.
No, they don't want to do it. They're doing this to get the I would assume, in many cases, the long-term tax-free growth.
Long-term tax-free growth.
So it's not an issue. Now, I'm sorry. If you already have deductible money inside of an IRA, does that
now you got problems?
Create an issue?
It does create an issue. Remember, I said if the entire traditional IRA is from that after-tax contribution, there's no taxable event when I move it to a Roth IRA. But let's say I make that $6,000 contribution on a non-deductible basis to my IRA. But earlier in the year, last year, years ago, whatever the case may be, I moved money over from my 401k into my IRA. I did an IRA rollover. And I had $94,000 in my IRA when I added the new 6 on an after-tax basis.
Now you got 100,000, 94 of which was pre-tax and 6 is after-tax.
And so if I'm going to move, I cannot separate the pre-tax and the post-tax. Everything that comes out of the traditional IRA is on a pro rata basis. So when I move the 6,000, presumably that's what I'm trying to do for the backdoor Roth, over to the Roth IRA, 94% of that 6,000 that moved is taxable. And 6% of it, because that's the ratio of pre-tax and post-tax money in the traditional IRA when I moved it, is going to be tax-free, which means I leave a bunch of basis sitting in my traditional IRA. So this is it's not, and now you had to do a Form 8606, and you're going to have a Form 8606 for the rest of your days with your tax return to try to calculate how much of your traditional IRA is pre-tax and post-tax when you start making distributions for required minimum distributions or for whenever you take money out.
Well, unless you decide to completely, liquidate it,
convert the whole thing,
and pay taxes on the whole thing, which
most likely doesn't make sense either.
Probably not. You're going to wind up paying more taxes than you planned.
So how do you get around that when you have bunches of pre-tax money? Now, I saw somebody who had $3,000 or $4,000 of traditional pre-tax money in their IRA, and then they started doing the backdoor Roth, and they said, you know what, I'm going to pay the tax on the 3 and be done with it and have all Roth going forward.
It's worth it not to fill out the form every year.
Yeah, and it was worth it to pay the tax on the 3 so they could have that $6,000 to $7,000 contribution going, indirectly into the Roth IRA. But what do you do if you've got that $100, $800 million traditional IRA? Well, if you're still working and you have a retirement plan at work, you could potentially move that money from all the pre-tax money from your traditional IRA to your 401k profit sharing plan at work. Now, how much is in your IRA? On a pre-tax basis, I got nothing pre-tax in my IRA anymore. As long as it's a company-sponsored qualified retirement account, a 401k, a tax sheltered annuity, a 457, a pension plan, a profit sharing plan. It does not work if the retirement plan at work is a SEP or a simple, because those are IRAs. They're going to be treated in the IRA world.
Yeah, and people tend, I think, to forget that.
So
easy.
There may or may not be a way around it. Now, some people don't want to do it because they like the investments in their IRA and they don't have that same option in their 401k, so they don't want to roll the money back to the 401k. Those are decisions that you can make once you know the rules. But knowing the rules, it doesn't, you're asking, why did Congress allow this? Who the heck knows? It's Congress.
Well,
does anybody put any rational thought into things when they do things?
Well, as we found out, many of them don't know how taxes work anyway. I mean, it's and
then they partially change the rules years later, and then partially change rules again years later, or they set some new rules up and they didn't realize it was affecting old rules already on the books, and things get really complicated.
They do. But ultimately, I think that you got to figure out if doing any of this stuff, and this goes back to paying off the mortgage or doing a backdoor Roth conversions, all that stuff, you need to talk to somebody who knows your individual situation. Because, Professor, no matter what the advice may be, it may be right for some. It may absolutely be the wrong thing to do for others. Would you agree?
I would totally agree. It comes back to the only appropriate answer the first time somebody asks a question. The answer is, it depends.
It depends.
Should I do this? It depends.
You won't know if it's suitable for you unless you talk to an advisor who can assess your situation. And I think anybody that you meet with should be able to tell you both sides and let you decide. But you may have reasons why you think it's not. And we talk about this, Professor, but it's so important to know what it is you're getting.
You got to find out what is in your best interest as far as what's going forward.
Absolutely. It's even more important now. We're out of time. If you want to know and you want to talk about things like Roth conversions, you want to talk about things like, do I pay off my mortgage? Or you have some other potential issues that you would like to discuss as far as retirement goes, saving, investing, insurance, all that stuff, you can reach Professor Rick Plum or any of the Lucia Capital Group advisors, 800-644-1150. That's the off-air number at Lucia Capital Group, 800-644-1150. They'd love to speak with you. Is it right for you to do a Roth conversion? I don't know. Is it right for you to pay off your mortgage? I don't know. You should find out because it's all up to your individual situation. It may be great. It may be the worst thing you can do, but find out and talk to one of the advisors. Professor, I have a thing. Speaking of which, next week, if I can get this correct, we may be talking about things like fees, and we may be talking about things like reverse dollar cost averaging, which I was told we brought up on a previous show. And we didn't say what it was. I think we did say what it was. But
it's the reverse of dollar cost average. Never mind.
Well, that plays into a whole buckets thing. So I'd like to try to get to that in an upcoming show, perhaps next if we can. So anyway, out of time. My thanks to Professor Rick Plum, certified financial planner professional, and all the other folks at Lucia Capital Group for allowing us to do this particular podcast, informative as it is. For Professor Rick Plum and the rest of the folks there, I'm Johnny Dean. Appreciate you listening. This has been Managing Your Financial Future, and we'll talk to you again next time.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by Lucia Capital Group, will be either suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59 and a half may also be subject to a 10% penalty tax. Roth IRA earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59 and a half or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk. Interest rate risk, bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall. Financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Insurance product guarantees are subject to the claims paying ability of the issuing insurance company and are subject to their terms and conditions. Rick Plum is a registered representative of and offers securities through Lucia Securities LLC, LSL, a registered broker-dealer, member FINRA SIPC. Advisory services offered through Lucia Capital Group, a registered investment advisor, and holding company for its affiliated broker-dealer, LSL. Registration with the SEC does not imply a certain level of skill or training. John Dean is an associated person of LSL.